The 7th of June. Another Friday is upon us. They run by fast as hell. Of course, I got Mr. Patrick Carroll back again because there are some details here within the market that I always bring him in to break it down. I can show you price action, my beliefs of what's happening, the different things that I'm seeing in technicals. But when it comes to really understanding what's driving those technicals, why things would flip as quickly as they do, which they just did, I bring in this man. So what's going on, brother?
How you doing, brother? Good to see you.
Doing all right. Not a kind of a false start to my day. I usually get up 4:30. I'm getting my stuff done, and when you grab grandkids that live next door, you don't always get to have exactly the way your day plans, which is awesome.
Yeah.
But I get to see them, which is great. Never going to turn down that opportunity. But now I get to
And
make
on
up.
non-farm payroll day.
Yeah, no, exactly. You go and get that too on top of it. So yeah, I'll get to all the stuff I was planning on getting to before I get to bed tonight. I'm probably gonna get an outdoor workout in 100 and yesterday's 113 degrees. Got one in. Gonna do another one today, probably 114, 113 degrees again. Sweat the hell out of myself.
Yeah.
So what we've got here, we're just going to get right into the stuff right now, guys. I'm going to get the share screen out because we've got, over a week's worth of trading that was all positive, and then all of a sudden, big old huge kick in the utensil today.
Yeah.
So, and I'll just say it's anticipated. We're watching these things. If you watch stochastics, meaning, how much velocity is going in versus how much really should be going in, we're in an overbought position, so heavily overbought. You'll see that my channels have changed a little bit. I like to track my channels and kind of see what I believe is going to happen. So we've had the channel that was created way back. I started building this way back here. We followed it until we broke out of it and then blew right through it. And then, of course, we hit that ceiling that I've been referencing for a very long time, worked down to another channel. Here we broke out of this one, high out of it because of CPI data. And now we're, what I believe, creating a whole new channel. I could be wrong. It's possible, but this is just me. This is me closing my eyes and throwing for the end zone, but with a lot of calculation on how far the end zone is and understanding the distance and where that receiver is supposed to be. So let's break down what has happened here from May 29th, 30th and on up until today. Patrick, do you mind just taking the horn and talk about that?
Yeah, no, we had some great data. So on May 30th, we had the GDP numbers come out. Economic growth was at 1.3%, which was dramatically lower than its previous print at 3.4. The very next day, the PCE came out on the 31st, which was another fuel, which is, that's the Fed's favorite gauge of inflation. And in looking at that, month over month inflation grew at 0.2%. The market was expecting 0.3. You know how I laugh about that, right? Because life's all about rounding when it comes to inflation indicators. And the actual number was 2.49, which still rounded down to 2.2%. But you're sitting here laughing as you're so close to it actually of being a 0.3, which maybe wouldn't have seen as aggressive of a move, right? But we'll take it. And then we rolled into the beginning of this week, and we saw ADP data missed pretty dramatically. We saw the challenger layoffs weren't near as aggressive. The number of job openings was at a 3-year low, right? So something the Fed was looking closely to. So everything
so let's
looked
pause
beautiful.
there 1 second, guys. Why would that be a good thing for mortgage-backed securities? If ADP report is showing that the jobs are not as aggressive, there's not as much movement out there, that means there's not as much money going into the market, not as much being spent. Hopefully keep inflation at bay. That's a good thing for bonds. Inflation being at bay means they're going to be putting their money someplace where they're going to get a better return because it's not being eroded from inflation. That's why I preach the 30-year fix is the greatest instrument, because inflation's eroding the dollar's value, therefore you're paying back less than what you borrowed. So just wanted to explain why that would have been a good market mover, because it was a big market mover that day. So all right, so go ahead with
Tremendous.
June 4th.
Yep. So we hit all through that wonderful, beautiful employment data. Everything was teeing up to look at a jobs report this morning for May that was going to miss expectations. There's one group that I study and watch. It's called Linked Up. Their entire platform is nothing but predicting the next jobs data. And they were predicting 125,000 jobs were going to be created for May, and the number hit 272, just totally blew everything out of the water. It missed by 117% on that. The market expectation was for 185,000 jobs, I believe. So it was 47% higher than that number, which totally squashed half of all of the gains we've observed over the past week and a half.
Look at that big move. So we had all this climbing out of the hole. We hit our peak, and bam, get just
Yep.
hammered right back out. And actually, we're now below what looks like the 100-day moving average. We've gotten down into other averages to be the support. We've broken through other support.
Yep.
So when you think about that, guys, that big of a miss means like there's a lot more money potentially being out in the economy, going to continue to push things up. And what the Fed is talking about these days, what their claim is the only way to get control over inflation is for less money to be in the market, less people
Yeah.
to have jobs. And then when you think about the jobs they have, there actually is really less jobs when you consider what's happening. You've got, some of the jobs being counted, as I understand, you can set me right if I'm incorrect,
Yeah.
Patrick, is not just dual income households, something like 3 and 4 income households with people
Yeah.
having multiple jobs. That's people trying to survive, not people out there pushing the price of things up. But what
Yeah.
we've done with the last few years, pandemic being one of the main reasons, is we've created these instant gratification people, right? When you think about being locked up in your house, not being out to go do things, being forced to segregate, even if it's just with a mask, that's a form of segregation. And then you get to go out and do stuff. And while you're internal in your house, what do you get? You get to click and buy, click and buy, click and buy. You needed that. That was the fuel for the person's personal psychology. Well, that hasn't stopped. People haven't
Right.
stopped freaking buying because their buying is pushing it up. Not only are we not going to see, this is my prediction, not going to see a rate drop from the Fed this year. It's highly possible to see a rate raise. And if we do see a rate drop at all, I believe it's going to be 100% politically motivated.
Yeah, I mean, you factor in kind of one of the things that's supporting your evidence there of the part-time scenarios is if you look at the labor participation rate. I mean, if you take out the small blip that we had in COVID with furloughs and everybody that lost their jobs, the labor participation rate, it's the lowest since 1975, where it's resting right now. So that would tell you that the participation rate is going to tell you the number of Americans that are engaged, right? So that tells you that a lot of these Americans are taking on multiple jobs in order to make this creation work. And then the unemployment rate also climbed to 4% today. So you had kind of a mixed bag, right? Where, hey, we've got 272,000 jobs created. However, unemployment rate went from 3.9 to 4, and the participation rate fell 0.2% as well. So, I mean, there's still some evidence that there's cracks in the labor market. We just haven't seen them yet.
Well, there's definitely cracks, and there's a question on the reporting. We have that big of a swing between ADP and what Bureau of Labor Statistics is saying.
Yeah.
There's also that concern. The other thing is, have they reconciled? Are we still having over 55,000 jobs per month coming from the public sector?
Coming from the government sector. I mean, looking at the report today, I mean, from what I saw, the government was responsible for 83,000 of those jobs. Healthcare was 86,000. That was one of the bigger prints. So, they're still coming from those influential sources.
It was 86,000.
Yeah.
Guys, that's not, my opinion, that's not contributing to the labor force. That's contributing to the expense of the country. Right.
Yeah.
That's adding more cost to taxpayers. And let's get down to who pays taxes, right? Okay, if you have a government job, I'm not shitting on government employees at all. Don't think that I'm doing this. If you have a government job and you're paying taxes on your government job, but that's a taxes funded that, and they're paying taxes on taxes, right?
Yeah.
So I don't count that as increasing the labor force personally. I could be completely unfounded with that. Mm-hmm. Then you've got those who are on Social Security or those who are getting some sort of assistance. We have a lot of people have come across into our country illegally that's receiving some form of assistance. What percentage is really contributing to operating our country?
It's
30%?
very small, right? Because to your point, I mean, government jobs, they really don't create, right? They don't create opportunities for additional job structures. They're not building companies that, you can bring in 500 new employees in order to run this new platform, right? So it's a little bit different.
Me doing what we're doing right here, shaking my ass every single day like I'm late on rent, trying to create the idea of real estate investing for people who may not have thought that before, trying to give the idea of that and guide them through that and help them get the financing. That creates jobs for my team, right? That creates jobs for people on the real estate side. That creates jobs, that creates housing for people on the out there that are renters.
Exactly.
When you're talking about a government situation, there is no give. It is from what I can tell, mostly take. Now, that's just my perspective. That's just where I'm seeing from my angle. My angle could be wrong, but I'm going to say that it's pretty freaking right.
Well, and the one interesting piece is if you even look at this year, I mean, all of the revisions have been downward revisions, right? So the 175 from last month was revised down to 165. So we're continually seeing this trend of an initial report, and then as the data continues to flow, we're revising it, it's revising downward. And so I guarantee we're probably going to experience that in the next report. This is going to be revised down by probably 20 to 25,000 jobs. I mean, it's just been the trend of the year.
At least it has to bridge the gap that we're seeing between ADP and the Bureau of Labor Statistics. One other question for you, and I think we probably ought to, because we've been going a little bit of time here. When you think back on the history of all this reporting, right? You've been studying this for some time. I've been studying it for a handful of years. Before I really started to understand it in the mid 2015-ish and that kind of thing, and a little bit earlier. So you start looking at all this reporting, when you start looking at different administrations and different groups that were running these departments, in history, have you seen that kind of vast revision going on? Or is this something because I know we've seen it, but this seems like every report, headline is one thing, revision is significantly different all the time, because headline drives the market, revision is almost ignored.
100%.
Is that practice been pretty heavy more recently in the last few years, or is it something that you've just seen pretty consistently over a long period of time?
It's a definite sign that the labor market's softening. You generally see that when the labor market's on a downtrend, which is what we're experiencing right now. So what it does for me is it further solidifies that the labor market's finally starting to see some cracks. Because if you go and look at these softening type platforms through historic patterns, it's always an indication of the revisions are always in a downtrend when the labor market's on a downtrend as well. So it just supports that.
Thinking post election, we're going to see a lot more accurate reporting on this. Right now, you have that real high reporting on the front, say, hey, see, look at what we're doing. We're kicking ass. We're creating jobs. There's no job creation there. And then when you've got the revisions trying to at least come closer to trying to be truthful, I think people love telling lies, but they also like, oh, I'd love to kind of slide in a little bit of truth in there so I don't feel so bad about myself. And that's what these revisions are doing. But I think we're going to have a massive, massive eye-opening bit of data come out after the elections. Any final words?
And let's talk next week too. So next week's going to be huge on the economic calendar. Tuesday, you've got a 10-year Treasury auction. Auctions have been receiving D grades. The participation in the auctions has been way down leading up to this. So Tuesday is going to be a big day. Wednesday.
Let's just do Tuesday and Friday. You good with that?
Yeah, let's go for it. So there could be some big changes next week too.
Tune in next week, Tuesday, Friday. We get deep into the weeds on those topics. So thank you, brother. Appreciate you, man.
You bet, pal. Have a great day.
Take care. See you guys on Tuesday.